Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Understanding gold ETFs like GLD. Gold ETFs, or exchange-traded funds, are financial products that track the price of gold. When you buy a share of a gold ETF such as GLD, you are buying a small piece of a big pot of physical gold stored in secure vaults. You don't own actual gold coins or bars, but your share value moves up and down with the gold price. Here's what makes gold ETFs stand out. Simple to buy and sell. You can trade shares during regular market hours from your brokerage account. No need to store or insure physical gold. The fund takes care of the security and storage, backed by real gold. Well-known funds like GLD hold bars in trusted vaults and undergo regular audits. Transparent pricing. ETF prices closely track the spot price of gold. Gold ETFs make it easy for regular investors to join the gold market without the usual hassles. You won't get to display gold on your shelf, but you get the exposure and can manage your investment from your computer or phone. Costs and fees associated with gold ETFs. While gold ETFs make investing simple, you'll pay some costs along the way. Unlike physical gold, which may only cost you a one-time purchase price plus storage, ETFs charge ongoing fees. You can expect expense ratios. This is an annual fee the fund takes as a percentage of your investment. For GLD, it's typically around 0.40% per year. That means for every $10,000 invested, you'll pay about Rs each year in fees. Trading costs. If your broker charges commissions, buying and selling ETF shares might carry a fee. Many brokers now offer commission-free trading, but always check bid-ask spreads. There's often a small difference between what buyers will pay and sellers will accept. It's usually tiny for big ETFs like GLD, but can add up if you trade often. All of these fees are much lower and more predictable than what you might pay to buy, store, and insure physical gold, but they're still worth factoring into your decision. Liquidity and trading flexibility. Gold ETFs like GLD are some of the most liquid ways to invest in gold. Liquidity means you can buy or sell shares whenever the stock market is open, and your trade will go through quickly at a price close to current gold value. Key reasons investors love ETF liquidity. Quick access. Need to sell in a hurry? You can usually turn ETFs into cash right away, unlike selling physical gold where you may need to find a buyer and negotiate a price. Low minimum investment. You can buy a single share or just a small number, making it easy to start with a modest amount. No headaches over authenticity. With widely traded ETFs, you don't need to worry about getting scammed by fake gold dealers. Partial sales. Sell as much or as little as you like, right from your brokerage account. ETFs give you the freedom to react quickly to gold price changes without the stress of handling the real thing. They fit the bill for investors who want flexibility and ease of trading, especially when compared to the slower process of selling actual gold. Risks, tax implications, and strategic allocation. Every gold investment comes with its own set of risks and rewards. Whether you hold physical bars or buy shares in a fund like GLD, knowing the potential ups and downs, tax rules, and how gold fits into your portfolio can help you avoid regrets down the road. Let's cover what to watch out for and how to make gold work smarter for you. Price volatility and market risk. Gold prices can jump around more than most people expect. Even though gold is often seen as safe, it's not immune to big swings. Market ups and downs. Gold rallies during scary news or when inflation spikes, but its price can fall when the economy recovers or interest rates shoot up. Short-term swings. If you check gold prices every day, get ready for a bumpy ride. Big price changes can show up overnight based on news, central bank actions, or currency moves. Unique risks for ETFs. With ETF shares, there's a small chance the fund doesn't perfectly track gold's price. Some ETFs also depend on other financial players, which adds a layer of risk. Physical risks. If you hold real gold, you face other risks: loss, theft, storage accidents, or trouble selling at a fair price. Gold can shine when stocks fall, but there are no guarantees. Treat it as a tool for balance, not a fix for all market worries. Tax treatment for physical gold and ETFs. Gold's tax rules aren't as simple as stocks or bonds. The IRS puts gold, physical, and most funds like GLD in a special spot for taxes. Physical gold. Bars, coins, and gold jewelry count as collectibles in the eyes of the IRS. Profits from selling after more than a year get taxed at a higher collectibles rate, up to 28% compared to the usual long-term capital gains. Gold ETFs. Most gold ETFs are structured as trusts, holding physical bullion. Selling shares you've held longer than 1 year still triggers the 28% collectibles tax rate. If you sell before a year, short-term gains get taxed at your regular income rate. Other gold funds. Some funds may follow normal stock tax rules. Double-check before you buy if tax planning matters to you. Don't forget. Brokers report sales to the IRS. Document every gold purchase, including date, price, and receipts, to keep tax time smooth. Planning ahead for taxes can save you money and headaches when you decide to cash in. Best practices for allocating gold in your portfolio. Gold can be a stabilizer, but overdoing it can water down your returns or leave you less flexible than you'd like. Deciding how much gold to own isn't one size fits all. Here are some guidelines to help you find the right mix. Keep it moderate. Most financial advisors suggest gold should make up between 5% and 10% of your total investment portfolio. This amount is enough to add a shield without weighing you down when stocks or bonds do well. Diversify types. You don't need to pick just one. Some people hold both physical gold and gold ETFs to split the pros and cons. Physical gold gives true ownership, while ETFs offer speed and easy trades. Rebalance when needed. Check your gold stake at least once a year. If gold's price jumps, it might start making up too much of your portfolio. Trim it back to your target percentage to keep other investments working for you. Mind your goals. If you want gold mostly for crisis protection, physical gold may make sense. If flexibility and quick trading matter, ETFs are hard to beat. Gold is a tool, not a cure-all. Use the right way. It protects against trouble and helps you sleep better at night. Used wrong, it can hold you back or confuse your tax bill. Smart allocation means enjoying the good while avoiding common gold mistakes. Gold stands out for its staying power and unique role in a well-built portfolio. Whether you like the control and certainty of physical gold or the ease and speed of ETFs like GLD, both offer ways to manage risk and protect your hard-earned wealth. Take time to weigh costs, storage needs, taxes, and risk before making your move. Adding gold, even in small amounts, can help your investment stay balanced through both good and bad markets. Trust your research and set clear goals for your gold investment. If you're ready to take the next step, review your current portfolio and decide where gold fits best. Share your approach or questions in the comments. There's always more to learn and discuss in the search for a safer, smarter financial future. Thanks for watching this video. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.